Welcome to Key Points for the month of March. Now, last month we cautioned the equity markets were somewhat due for a pullback. And to be honest, the correction that we saw in February was a little more severe and a little quicker than we had anticipated. Now, this month we're looking at three things. We're looking at inflation, bond yields, and the outlook for equities from current levels. Now, turning to our first point on inflation. One of the reasons that equity markets sold off in February was that inflation fears began to pick up. In the United States, core CPI inflation was up 0.3% month on month, a bit higher than expected, and that was accompanied by average hourly earnings rising by 2.9% on a year-on-year basis, again higher than expected. Now, there's a couple of things we would point out. Firstly, in terms of the United States, yes, capacity is shrinking, and yes, we anticipate inflation to pick up a bit. But we don't expect it to get out of hand, and we think the pace will be gradual. And indeed, on average hourly earnings, this is a positive because they've been running at a very low level for a very long time. And importantly, although average hourly earnings are picking up, productivity is also improving, which is likely to keep inflationary pressures through wage growth somewhat contained. The other fear about inflation was that central banks would become more hawkish, and that's something that we don't believe. We think the Fed will keep the pace of tightening consistent with their messaging, but we don't expect the ECB or the BOJ to curtail their quantitative easing anytime soon, or certainly sooner than expected. Now, when we turn to our second point around bond yields, we always have the view that bond yields would drift gradually higher. But the move that we've seen in the last sort of 4 to 5 weeks we think is somewhat excessive, partly as a function of those inflation fears. Now, we think in the short term, we think bond yields are likely to be peaking out. We think they'll come back in a little bit before ultimately moving out later in the year. And again, there are a number of reasons for this. One, as I said, we think inflation fears in the short term are overblown. But importantly, economic data that have been running so strongly over recent quarters, we think is likely to moderate somewhat. And indeed, we've seen a little bit of that in terms of some of the global PMI numbers. Nothing to be concerned about, but just the rate of change is beginning to moderate a little bit. Still a good growth dynamic, let's be clear. Now, turning to our final point on equities, we had anticipated a bit of a pullback, and we always had the view that this would be the pause that refreshed, allowing the bull market to run for longer. And therefore, we're quite encouraged by the market movements that we saw over the course of February. Investors have realized it's not a one-way bet that equities always move up. Volatility has picked up, I think rightly, given the uncertainties that still persist. But the key message is that the pullback was just a pullback, and we do believe, again, over coming months, equity markets will move higher. Remember, all our publications can be accessed via www.zurich.com/MSME, and the full report accompanying this video is available there.